Okay, Chapter 15 investments. We're going to talk about options markets for Chapter 15. So the first options we talk about are a call option. A call option is a right to buy an asset at a specified exercise price on or before a specified expiration date. So I would say it would be something like I'm buying the rights to purchase a share of stock by December 31st, 2020 at a specific, say, price of $80, whatever that number is, but that's what a call option is. The strike block price is the price set for calling or putting the asset, for either buying it or selling it. A premium is the purchase price of that option. So premium is the difference between what the actual value is versus you buying the rights to buy it. So the price that you're actually paying for the option itself. So this is an example. It has Microsoft here, where we shows both the calls and put options listed for each exercise price and expiration dates. So when the expiration dates are, what the strike price is, what the call and put options cost, and the differences in prices. And the underlying stock price is $71.75. So you can see kind of what the difference. These would be the premiums, right, for the cost of the actual put or call option. A put option is a right to sell an asset at a specified price, so I have the rights to sell it. So effectively, that means that someone has to buy it, or the company that is underwriting this has to buy it. If a option is in the money, this means at the end that the exercise would generate a positive cash flow. So, for example, over here, if you take the premium out, which you wouldn't do, but take the premium out, buying the put price of $74 here. Once that reaches over $74, then we're in the money. Out of the money means the exercise would generate a negative cash flow. So effectively, whether a call or put option is if I act on it now, if I exercise it now, will it create a positive or negative cash flow? And at the money is when it's exactly the same. Options trading. Most trading occurs on organized exchanges. There's a real ease of trading. It's a very liquid secondary market, standardized by allowable expiration dates and exercise prices, limited to a uniform set of securities. Results in a more competitive market, since we can have call and put options out there as well. There's a difference between American options and European options. The American option can be exercised on or before the expiration date, whereas the European option can only be exercised at expiration. So if this was European and not American, I mean, you could only do this on June 16th, or you could only exercise this one on July 7th. The Option Clearing Corporation is jointly owned by the exchanges. It arranges for exercise options through a member firm. Through member firms, required to option writers to post a margin. Other listed options, there's also index options, where you can call and put based on the stock market index. So you can buy an option to buy or sell individual stock based on, if the market does something. So you have a strike price for the market itself as a whole, and you could have a call or put based on that strike price from the market index. Futures options gives the holders the right to buy or sell futures contracts using the exercise price as its futures price. Foreign currency options offer the rights to buy and sell foreign currency for a specified amount of domestic currency. So it's very similar to a put or a call, except for we're talking about specifically for foreign currency rather than for stocks. And then interest rate options on securities, notes, bonds, and bills like other countries and government bonds. And that is an interest rate option, again, trying to leave yourself an option to buy for when there's vast changes in the interest rate, and you can be call or put. All right, the payoff at the expiration. So the payoff to a call holder at expiration, ST in this case equals the value of the stock at the expiration date, and X is the exercise price. So if ST is greater than X, then 0 if ST is less than or equal, or sorry, ST minus X if this value of the stock at the expiration is greater than the exercise price. 0 if ST is less than or equal to ST at the expiration. If X is greater than or equal to. The payoff to the call writer If ST is, and again, that's my value, let's talk with the expiration, is greater than X, then it's the negative ST stock price minus the exercise price. 0 if it's less than. Put option, payoff to the put holder, 0 if ST is greater than or equal to X. If not, if X minus ST, if X ST is less than X. This is effectively just showing you how the money is going to change hands when the option expires, depending on which direction it goes, whether you have earned money or not, and whether it's a call or put option, as to whether the money, which direction the money goes, if any. Okay. So this is the payoff profit for the call option expiration. So S sub T on the horizontal axis is my horizontal axis. In this example, we're talking about an $80 option. So hold on 1 second here. Okay, sorry. So for this is an $80 option. So for the stock price of 80 or below, the option would expire worthless. Above 80, the option is worth excess stock price over $80. The option's value increases by $1 for each dollar the increase in the stock price. For every dollar of increase in the stock price. The solid line is the value of the call at expiration. The net profit equals the gross payoff less the initial call. Suppose the call costs $14 and the profit to the call holder would be the dashed line, the bottom line. At the option expiration, the investor suffers a $14 loss if the stock price is less than or equal to $80. So this is if the stock price is $80, there's my $14 difference. But if the stock price obviously climbs over that, then that's when we could potentially see profit. Okay, so this is a payoff prior to a call, riders of expiration. So this is a payoff and profit diagram for the call writer, the one who's actually writing the call. This mirrors the image that we just saw for the call holders. The break-even point of the option writer is also 94. The negative payoff at that point, it just offsets the premium's originality it receives when the option was actually written. So you can see $80, a $14 profit, and the profit goes down. And once it hit 94, that's its break-even point where there's no profit beyond that. Payoff value of a put option at expiration. So this solid line here plots the payoff at expiration of the FinCorp at the exercise price of 80. If the stock price at option expiration is above 80, there's no value and has the right to sell the shares at $80 and it wouldn't be exercised. Below the price of 80, the put value at expiration increases for $1 for each dollar the stock price falls. So effectively, what we're saying here is this distance between this here and here, $80 would be the potential profit for anything that is below $80, because I can sell it for $80. All right, option versus stock investment strategies. We invest entirely in stock. This is an option. 100 shares for $90 each. This is one option that we can do. So these are different strategies we can use for stock investment. Another option would be invest entirely in at-the-money options, buy 900 calls selling at $10 each. And the third option is buy 100 call options for $1,000, invest the remaining $8,000 in a 6-month T-bill. And we're going to look at, okay, these are 3 different strategies. This individual has $9,000. All these options cost $9,000 effectively. We're going to see which strategy A, B, or C would give us the best return on that money. So you can see if we do option A and what the difference in stock price is, what our return is. Notice the call options are not in the money until it goes beyond $90, and then we become in the money. But also notice that after it goes over $100, that the option price becomes more and more valuable, substantially more valuable than just buying 100 shares. And then you'll see that effectively the 100 calls plus the $8,000 in T-bills kind of just, is less drastic than just buying 100 shares. This one's less risky, but it also has a little bit more of a guarantee. And the rate of return on these as you can see, is 0 because 0 is negative 100% for the 900 put options at 85 and 90, negative 5.5% here. 0% went at 9,000, but then it continues to go up. And then notice we've got negative numbers all the way up to $95 for both options B and C. Then starts to become positive once we get above. It's 0 at $100 for this one, but it becomes positive for this one at $100 each. So this is the different valuation of the stock prices. And as you can see, some of these lines curve more drastically, or have a much steeper slope than the other ones. So we have option A here, option B, where we have all options, and then option C. So notice also, though, that the chance that we've got this chance here of negative profits compared to some of these other ones where we really don't, or it's a very low likelihood of a negative return. Okay, other option strategies. There's a protective put. Protective put is an asset combined with a put option that guarantees a minimum proceeds equal to the put's exercise price. And risk management is a strategy to limit risk in the portfolio. And a covered call is writing a call on an asset together with buying an asset. So and we're going to look at all these in graph form here in just a minute. So option strategies, and I think they're easier to see when we're looking at graphs personally. We have the straddle, a combination of call and put, each with the same exercise price on the same and expiration date. So effectively, I'm hedging my bet in this case when I'm straddling. Would be the phrase I use for it. A spread is a combination of 2 or more call options or put options on the same asset with differing exercise prices and timing of expiration. So we're betting on the difference between the two to be more valuable. The collar is an option strategy that brackets the value of portfolios between 2 bonds. So this is a protective put strategy. We have the stock and we have the put and what the value of it is. And remember, X is my exercise price and ST is the value of the stock at the expiration date. And so this would be his first graph. Okay, shows the payoff of the stock at a 45-degree line from the originating at the origin. Here is the payoff of the stock. The second graph, the payoff of the put, and the line starts on the vertical axis and slopes downwards at a 45-degree angle, touching the horizontal axis here. Okay, so the payoff of stock, payoff of put, and if I combine the two, the payoff of the protective put is a solid line known as X sub ST equals X. When it bends the slope upward, this graph shows profit is the dashed line, horizontal at X minus sub 0 P. So we've got our loss line here and then our profit line as we go up as it slopes upwards. So profit on stock is an upward sloping line from negative S. We got those profit on stock here, crossing the horizontal axis at X, which is at the expiration date. Profit on the protective put portfolio is a horizontal negative P here above sub-zero S until X, where it bends and slopes upward, crossing the horizontal axis, the right of profit on the stock. The distance between the lines at X is labeled sub-zero. S sub-zero equals X, so this difference right here. So this is a payoff for a covered call. So again, on the first graph, the payoff option for the stock by itself is a 45-degree line. Okay, and then again for the second graph, we've got a payoff for the written call as a 45-degree line after point X going down. But for C, the covered call, the payoff covered call is an upward sloping line from the origin of S sub T, and that's equals where it equals X, where it bends and becomes horizontal. Also, this graph, profit dash line sloping upwards from negative sub SC minus SC. It slopes upward until the horizontal value is X, the expiration, and becomes a horizontal line as the profit is parallel to all payoff at that point. All right, payoff on a straddle. Remember, payoff from the call and put. So we're going to call and put both. So payoff on the call is horizontal 0 until X, where it bends and slopes upward. Profit is a parallel line originating at negative C. Okay, so here's my profit line. Second graph, the payoff of a put. The payoff slopes downward until X, where it bends, and the horizontal at 0. The profit is a parallel line that originates below the payoff at X minus P and bends to the negative P. So we're still at point X on both of these graphs. Third graph, the payoff slope down from X to X0, where it bends 90 degrees up and slopes upward. The profit is a parallel line that originates below the payoff at X minus P minus C, X minus P minus C, right here, I'm talking about, and bends at a negative P minus C. The distance between the two lines is labeled P plus C. This is the payoff on a bullish spread. Payoff on the first call, payoff on the second call. So first graph is held. The payoff line is a horizontal at 0 and until X, and sub 1 it starts to bend upwards. It's horizontal until it reaches here, then it starts to bend upwards. The profit line is horizontal sub C until it hit X, and then it starts to bend upwards. Portfolio B, a call written with a strike price of X sub 2. The payoff line is horizontal at 0, which makes sense. The payoff line is horizontal at 0 until X sub 2, which is right here, where it bends downward. The profit line is horizontal C sub 2 until X sub 2, then it bends downwards too. For the third one is a bullish spread. The payoff line is horizontal at 0 until X sub 1. The payoff line is horizontal at 0 until X sub 1, where it bends upwards and slopes towards X sub 2, and then levels off again and becomes horizontal. Okay, a callable bond issued with a coupon rate higher than on straight debt. Okay, but a callable bond means that the company has the right to pay that off early and can do what they call call the bond, in which case they would pay the face amount at a given time frame whenever they choose to call the bond. Investors' compensation for the call option is retained by the issuer. This usually includes call protection period. So the value of straight debt is this 45-degree angle. This will be the value of straight debt. The value of a callable bond, it starts off on that 45-degree angle. Then when it reaches the call price, then it levels out. Whereas the value of the straight debt itself continues to grow after the value of that call price. Convertible securities convey options to holders rather than the issuer. Typically give the holder the right to exchange for common stock regardless of the market price. So you can sell bonds or bonds with warrants that can give you the right to purchase stock when you choose to as the one that actually owns it. This is from the owner's perspective, the owner of the security. So we can see what straight debt value does for stock price, conversion value, and you can see when we have the convertible bond value that it starts to mirror. So it goes one direction and then it starts to mirror. But at the beginning it mirrors a straight debt value, and then once it reaches this point here, that's when it starts to follow the convertible value for the conversion amount. Well, warrants are options issued by a firm to purchase shares of firm stock. Collateralized loans are non-recourse loans, no recourse beyond the right to the collateral itself. So it means it's secured. It's also called a secured loan, where there is only a right to whatever the loan is being secured with. Collateralized loans in 3 views. So it gives an implicit call option to the borrower. The borrower turns collateral over and retains the right to reclaim it by paying off the loan. The borrower will repay L dollars and can sell collateral to leaders for L dollars, even if S sub T is less than L. Here's an example of a collateralized loan. When S sub T exceeds L, the loan is repaid and the collateral is reclaimed. Otherwise, the collateral is forfeited and the total loan repayment is worth only S sub T. Leverage equity and risky debt. Anytime a corporation borrows money, the maximum possible collateral for the loan is the total of the firm's assets. All right, different more exotic options. Asian options, options with payoffs that depend on the average price of an underlying asset during a portion of option life, rather than it being, a given strike price or a given put or call, but it's an average. Currency translated options have either an asset or an exercise price denominated in a foreign currency. And digital options have fixed payoffs that depend on the price of the underlying asset itself. And that is it for chapter 15.